Well, China is one of the things that's being taken into account in a big new report coming out just today from JPMorgan. JPMorgan Asset Management is coming out with their 23rd annual 2019 long-term capital market assumptions report. It's focused on helping investors and advisors understand the headwinds and opportunities in the current late cycle economy. For 2019, for example, they're projecting 2.5% global growth, increased cyclical risks. They say the U.S. economy has increased stability, but it may not grow as fast as it has in the past. For more on the report, we welcome now David Kelly, JPMorgan Asset Management's Chief Global Strategist, and John Bilton, JPMorgan Asset Management's Head of Global Multi-Asset Strategy. JPMorgan Asset Management oversees about $1.8 trillion in assets. So welcome to both of you. Congratulations on getting it out. So David, first of all, as I understand, you had 35 people, 9,000 hours, 6 months. So not much work went into this.
And a lot of cup of coffees. But we take it very seriously because we spend so much time thinking about the short term in markets, but really for our institutional clients, for our mutual fund clients, they have very long investment horizons. So what we want to look at is, well, what does this mean for the next 10 to 15 years? And so we, over something like 50 different asset classes and sectors, we try to provide assumptions of what these numbers are actually going to be like so they can plug them into their models.
So John, let's take one thing that we just talked about, 2.5%, I understand that. Increased cyclical risks.
Yeah.
Translate that for me. What does that mean for me if I'm an investor?
Well, simply put, I mean, whether you're a long-term investor or a short-term investor, you need to understand what are the drivers, what are the structural drivers of returns, things like earnings growth, long-term dividends, buybacks, etc., and what are the head or tailwinds, valuation margins, etc., that may be coming through because of the current state of the economy. For instance, in US equities, we think we probably see 5.25% potential growth on average each year for the next 10 to 15. If we reach equilibrium, starting from fair valuations and fair margins, that number's 7.6. So actually, US equities look pretty good, but we've got to deal with the fact that the cycle presents some challenges for us as investors.
So from an economic point of view, the story this year was U.S. has great growth. We're outperforming the rest of the world on growth as well as equities. Is that the story that you see in 2019?
Well, not really, and the point is that for the long run, of course, that's exactly why you do these long-term assumptions, because what we see in the short run is a lot of fiscal stimulus in the United States that's pushed up U.S. economic growth. We had a big tax cut, which has pushed up margins. But if you look at some of the papers that we put into this, one of them is on growing government debt, and eventually that could put a squeeze on even corporate tax rates in the United States. And then also, we've got labor supply constraints, which are going to slow growth in developed countries in general. That's why we still think that in the long run, emerging markets will outperform both in terms of stock market returns, but also actually in terms of economic growth.
And John, what about that debt, particularly public debt? Because one of the things you say is you don't expect the big economies to really take that on. They seem to be avoiding that problem. What's the risk in that?
Well, this is one of the things that we've talked about a lot. We've talked about the notion of managing outside the mean. And the idea there is recognizing when mean reversion matters and when new equilibrium are being formed. And what we're seeing with debt is if we're operating in a period of relatively sluggish growth, interest rates remaining low and quite stimulative, the incentive to reduce debt loads on governments is lessened. And that can create a situation where we're operating in a different environment. Bigger central bank balance sheets, larger debt to GDP loads, structurally lower interest rates. And that flows through into all of the different asset forecasts that we make for the next 10 to 15
It's kind of like when you reach a certain stage in your life, your doctor may give you a medication and say, oh, by the way, you're going to be taking this for every day for the rest of your life. We may be in a situation, given debt and slow growth, where we're going to have central banks keeping interest rates much lower than they have in the past, but even lower than their own targets. And that's one of the things that we're looking at here. In order to help governments finance this big debt load and to stimulate growth, we may see very low interest rates for a very long time.
Which raises the question, if you're looking at stocks versus bonds, where are you going to get the better return then going forward in that kind of scenario?
Well, I mean, this comes through very clearly. If we look at what's happened in the United States, bonds are back. The returns that we're seeing available from, say, the 10-year note now are getting close to what we'd see at equilibrium. And if we look in Europe, actually returns are still exceptionally low. And that dictates two economies, one which has normalized its interest rates quite some way, the United States, and one that's yet to get off the ground, which is Europe. And as a result, I think if you're looking at this in the US, you've got a classic late cycle environment playing out. And investors can dust off the old playbooks to work through that and hopefully collect the better returns into the future. In Europe, it's still much more tricky because we've got interest rates still stuck on the zero low.
That's really why our theme is sort of managing beyond the mean, because to be honest, the mean is pretty mediocre. and a lot of institutional investors and mutual fund investors will not be satisfied with what they can get from a plain vanilla portfolio. So you've got to exploit what you know about where we are in the cycle, about changes in the way the economies are behaving, or the changes in the way private and public equity markets are behaving, for example.
And what does this analysis tell you about volatility and risk and liquidity?
Well, I think, first of all, in terms of the volatility of the economy, some of our research suggests that all around the world, economies are actually getting more stable. So we'll have fewer recessions, but there'll be milder recessions and, by the way, weaker recoveries. But also we've seen an evolution in equity markets. We put a lot of work into alternative investments because, frankly, as stocks are kind of more like a bond these days. They're just paying out a lot of income. They're not really taking as much entrepreneurial risk, but they're also, because of that, not going to give us the best return. So we look at private equity also, where you've got an illiquidity risk, yes, but you can get paid for that risk.
And this is something we pick up a great deal on, because we're recognizing as the cycle turns, whether you're a short or long-term investor, you have to plan through it. And that means not just thinking about market risk, but are you being appropriately compensated for other moments of risk, like illiquidity risk? We're very good within finance at looking to be paid for market risk in returns.
Yeah.
That's what Markovits told us. We're perhaps just beginning to challenge ourselves to be paid for other elements of risk, and it's that where we can pick up improved returns.
But what does that wind up doing then during the next downturn? Because if you have investors in illiquid assets, for example, even if they're going to get compensated that they're not normally into, for example, in a world where you do have tightening conditions, and correlations are actually higher across the board and across assets sometimes. What does that mean?
Well, I think ultimately it means that there is a requirement not to avoid risk, but to know the types of risk you're taking. If you're taking an illiquid asset risk in a portfolio that requires daily liquidity, there's a big question to ask of your construction. If you've got deep pockets and a very long-term time frame, then taking illiquidity risk and being excessively compensated for that can be a very good portfolio strategy. Late in the cycle, it's really important that we think not just about the mean returns, the average expected returns, but we think about the distribution of those and understand what best is appropriate for the portfolio structure that you have and the cash flow requirements that you have within that portfolio.
So, David, we started the segment talking about China, actually, with the PMI numbers. To what extent does the fate of China really read across your analysis, your longer-term analysis?
It does feed into it. Obviously, China is a bigger and bigger part of the global economy. We do see China slowing, and very often, as we go through this year after year, we realize that our long-term numbers for China keep on coming down, just because China is getting bigger, it's getting richer, but it's also getting more mature. There are short-term issues with China also. We're not going to try to project sort of a blow-up in China here or specific market events, but we recognize that China will grow more slowly, but other countries like India will grow more quickly.
I think China's really important from an asset market perspective as well. It has a vast bond market, which has only about 2% of international holders. One interesting stat we found was that your average international bond manager has probably more dollar exposure to Belgium than they do to China because of how much of that market is held by international investors. China is a huge untapped potential market for asset investment that we think will grow over the next 10 to 15 years to meet its the size of its economy.
Yeah, so we have a question from a viewer, actually, I want to insert here because it really ties China back to the United States in this sense. The question basically is, if it takes $7.50 of new debt for each $1 of GDP growth, aren't we in a slow 2% growth arena for years? It's like China in the sense that they're buying growth. They're borrowing more than their GDP is growing. Is that sustainable in the long run, David?
Well, I think China is trying to make a transition. We need to make a transition too, because ultimately it's not government debt that drives growth. It's innovation, it's freeing up regulation, it's rewarding enterprise. China needs to do that. We need to do that also.